much to everyone for joining. Welcome to the session today. Just a couple of housekeeping mentions. If you can have your cameras on, that'd be great. And microphones muted, that would be fine too. It's a pleasure to welcome Tansy Jefferies. Tansy graduated from Cambridge University. She's a chartered tax advisor. Started her career, I'm just adding more people, just bear with me. Started her career with a top 4 accounting firm in the UK and has spent the last 24 years with RSM. She is currently, and has been for a while, the transfer pricing lead for RSM in the US. So Tansy and her team have supported countless clients with embarking on expansion into or international trade and looking at developing tax efficient structures. So she's very kindly prepared a presentation to share some of her insight with us today. We are going to have questions throughout. We think the best way to do that would be pop the question in the chat. I can introduce you to ask a question if it's appropriate throughout the presentation, but we will have time at the end for a Q&A as well. Just to let you know, the session is recorded for people who haven't been able to join who wanted to be here. So thank you so much, Tansy. I will pass across to you.
Thanks so much, Chris. Really appreciate the opportunity to be here today. So thank you for inviting me. Thank you everyone for joining and taking your lunch hour, assuming you're on Eastern time zone, to join us today. I'm excited to be talking to you about my favorite topic, which is transfer pricing. I have been with RSM for 22 years now, as Chris mentioned, and that is the one area of expertise that I specialize in. So I'm going to talk a little bit about general international tax concepts and some of the other considerations of expanding internationally. But the focus of my conversation is going to be around transfer pricing. But I'll also explain how that does connect back to all of those other concepts that I'm going to just quickly highlight. And then to the extent we have time, I'm going to talk a little bit about BEPS, base erosion and profit shifting, because that really does form the foundation of everything that we do internationally from a tax standpoint now on a global scale. So I wanted to give you some quick updates and highlights on that. I'm terrible at keeping an eye on the chat, so I have asked Chris to shout if there are questions in the chat so we can pause throughout if you have questions. Otherwise, I'll try and leave some time at the end so we can have some discussion as well before we wrap up. So just in case you're not familiar with RSM, a very quick introduction to us. We are the 5th largest accounting firm in the US, so we lead the middle market. We focus on serving middle market clients. In the US and Canada, we're a $4 billion firm with 16,000 employees. We also have services in India, service centers in India and El Salvador. And I'm really excited actually because we are in the process of merging with our UK member firm. So by the end of this calendar year, hopefully our organization will also include UK and Ireland as part of that merger under one firm. But we are part of the RSM network. So we do have member firms in 123 countries around the world. So I spend a lot of my time partnering and working with my colleagues around the globe. All right, so this slide has just some highlights on a few key considerations for any company that's either beginning to think about expanding internationally. So really talking about having a presence in another country versus simply selling into that jurisdiction. And also if you're looking at potentially expanding your footprint, if you're already international, but you're looking at potentially moving into other jurisdictions or regions, these would be some of the things you would want to be thinking about. Now, we could probably spend an hour, a week, a month on each of these. So I'm just going to do a quick spin through, and then we'll focus on what you can probably tell is my favorite topic, and that is transfer pricing. So we want to start off, first of all, thinking about our legal entity selection. So to the extent you're thinking of setting up some form of operation in another jurisdiction, you'll want to be considering, well, what type of legal entity should I be operating through in that country? You want to think about the corporate law aspect of things also in terms of the legal liabilities and what type of entity makes sense from a legal standpoint, but also from a tax standpoint. Typically, considerations are focused around whether that should be a corporation or some type of transparent or flow-through entity for US purposes. And I'm going to assume for the most part, we're talking about US headquartered companies. But if anyone in the audience is with a company that has a foreign headquarter, foreign parent, feel free to stop me if you have questions on how it might be conceptually different. But for the most part, the considerations are broadly similar. So for US purposes, we can typically select whether we want an entity to be regarded or disregarded for tax purposes, which will dictate whether or not you aggregate all of the income or loss from those subsidiaries into your parent company's taxable income or loss. So that's an important consideration as you start to operate. Also, you may find you either by design or inadvertently could trigger a branch in a foreign jurisdiction by virtue of having some activity in a country when you're initially in that startup phase. Some people do that by design. Sometimes you may not realize you've triggered a taxable presence. So you might hear the concept permanent establishment. That means effectively you've undertaken some activities in a foreign jurisdiction that's caused you to fall into that country's tax net. So now you may have created a foreign branch of your US entity in that jurisdiction, and you may have to file a tax return for that foreign branch. So that's another consideration. At what point do you want to switch from a branch operation to maybe a true legal entity? Then the next step would be thinking about funding. So how are you going to fund that legal entity? So typically there we're thinking about debt versus equity. Countries have different rules and regulations around debt and equity levels. So there's often thin capitalization rules that require you to maintain certain ratios. That can also then have implications in terms of how much interest expense you're able to deduct. If you're paying interest out of that subsidiary, it could be limited based on those thresholds. And I'll explain why this plays into transfer pricing shortly as well, but that debt could be third party or it could be intercompany debt provided by the headquarter, for example. Incentives are another area to consider when you're expanding, particularly if you have choices about which country or countries you want to maybe look at, especially if you're thinking about things like R&D activities. There can be some really great incentives around R&D operations around the globe. There can be export incentives. So that would also be something to look at. Free trade zones. Obviously, we're going to talk about tariffs a little bit today as well. Clearly a hot topic right now. There can be export incentives around services, for example. Puerto Rico has some great export incentives, which although that's not typically thought of as a foreign jurisdiction for tax purposes, it is. It's a separate jurisdiction from the US from a tax concept standpoint. So we see a lot of clients utilizing those opportunities. In the US, we have our foreign derived intangible income regime, which gives you a discounted tax rate. It's approximately 13% on certain exports. And I did see in the tax press recently that the Trump administration is starting to talk about potentially some kind of export credit, I think to kind of mitigate the impact of some of these reciprocal tariffs that might be having on US businesses. Nothing concrete on that, but we're going to be keeping an eye on that. So these are all things to think about and how that might impact your business as you're starting to look at that international expansion. Reporting requirements, obviously, if you go into a foreign jurisdiction, you're going to have additional reporting requirements. So ensuring you understand what those are and your deadlines, etc., is important. But one thing I did want to highlight too, if you're a US headquartered company and you have foreign subsidiaries, if they're controlled foreign corporations for tax purposes in the US, you have to file what's called a 5471. That's a form that attaches to your federal income tax return. They get longer and longer and longer every year. They're extremely complicated. We have a team of people that really specializes in completing those forms. A lot of it is disclosure of information. It's not necessarily all utilized to calculate your tax position, but there's a lot of transparency, a lot of disclosure now. If you have signatory authority over foreign bank accounts, there may be disclosures you have to file. And there are very severe penalties for failing to file these forms or for getting these forms wrong. So those 5471s, the penalty is 25,000 per form if you either omit to file it or if you have a material error on the form. So let's say you have one sub and you haven't filed that form, 4 years, 4 missed forms, 100,000 penalties straight away. So really important to be aware of the reporting requirements. Foreign income taxes, obviously, this is when you're going to be thinking about how much tax do you have to pay in those foreign jurisdictions. An important consideration is what the tax rate is and how you're then potentially able to offset that tax or utilize that foreign tax credit. There are ways you can potentially credit it or deduct it. And that's important because clearly you don't want to pay tax twice on the same income in different jurisdictions. Withholding taxes are something to consider also if you're looking at your structure and how you plan to move funds around the group, the types of intercompany flows that you might have, or even external flows that cross borders, because typically a tax jurisdiction will want you to withhold tax on any outbound payments on behalf of the recipient of that payment. So, for example, if you're paying interest, cross-border, dividends, royalties, some services, some rents, there's generally some type of withholding obligation. So you need to understand what that is. It could potentially be 0%, but there may still be some filing and compliance required. From a US perspective, the standard rate is 30% withholding. Oftentimes we find that rate is reduced by a treaty. And so that leads me on to the next point. You'll want to look at, is there a tax treaty in place between the US and the country in which you're looking to expand, or between your sister companies in the group, because those treaties will potentially dictate any reduced rates of withholding tax and any other kind of favorable abilities to mitigate double taxation by doing business in those jurisdictions. And it's important to note with tax treaties that they all have what we refer to as an LOB, or a limitation of benefits clause. So that prevents what we refer to as treaty shopping. You can't just put shell companies in a structure to try to leverage the benefits of particular tax treaties if it's all artificial. There'll be some way to kind of look through that and make sure that you're truly entitled to take the benefit of that treaty. So looking at real beneficial ownership. So it's important to make sure that those treaties will indeed apply to you as well, and look at those limitation of benefits clauses. And then indirect taxes. So this is an important one, obviously. Tariffs are top of everyone's mind right now. I'll talk a little bit more about that as we get onto the transfer pricing discussion, but also consider any other types of indirect taxes, especially VAT is a big one. Especially in Europe, you're going to see a lot of VAT compliance requirements, and other jurisdictions as well, but outside of the US, VAT is a big one to consider. Obviously, we're familiar with sales tax in the US, and we may see that in other jurisdictions as well. And then that brings me on to my favorite topic of transfer pricing. So just before I move on, Chris, I can't even see the chat with my screen share. Do we have any questions yet or anything? Oh, you're on mute. But I think you said no.
Sorry, I did. Yeah, no questions as yet.
Okay,
But I'm
perfect.
Thank you.
Thank you. All right, so I'm going to assume little to no knowledge of transfer pricing for today's discussion. So apologies if I do have any international tax or TP experts on today, bear with me. But I want to make sure I just give some of the foundational information before we talk about some of the planning opportunities. So let's start with what transfer pricing is. Is the pricing of transactions between controlled entities or related parties. So let's imagine in this scenario that we have, say, a US parent company. Let's assume they have intellectual property like patents, things like that they own, and they develop, they do all the R&D. Then maybe they have a manufacturing entity in China. Maybe they have another entity in the US, which purely serves as a distribution entity. You could have lots of different transactions occurring within this group that would be subject to transfer pricing rules. So, for example, manufacturing entity in China sells tangible goods into the US for further distribution. that is a related party transaction that's going to be subject to TP rules. We may also have IP transactions. So Chinese entity has third-party customers as well, and it sells to those third-party customers, but it's using the US patent for whatever the product is. It may have to pay a royalty to compensate for the use of that IP. We may have services. The US parent company may provide headquarter services, management functions, back office functions to affiliates around the world. These affiliates, there should be a service fee that's subject to transfer pricing rules, and intercompany loans. So to the extent you have an intercompany financing arrangement, again, that would be caught under the transfer pricing rules. So why do we have transfer pricing rules? Well, the purpose is to ensure that taxpayers are clearly reflecting the income attributable to those controlled transactions and preventing the avoidance of tax. So in that example, given that all of those entities are controlled, you could manipulate the pricing of any or all of those transactions. And by doing so, you could shift income or losses from one jurisdiction to another. So transfer pricing prevents you from doing that in a way that's egregious. You have to operate within the parameters of transfer pricing rules to prevent the artificial shifting of income. So the guiding principle of transfer pricing is that the results of the controlled transaction should be consistent with the results that would have been realized if uncontrolled taxpayers had engaged in the same transaction. So we refer to this as the arm's length principle. So what that means is you think about what would third parties do. So if this transaction were to occur between two uncontrolled entities, how would they price it in reality? So that concept seems pretty straightforward, logical, but then how does that actually translate in practice? How do we determine what a third party would charge for a transaction? And so in order to understand that, we have to undertake what we refer to as a benchmarking analysis. So we typically look for data that we can analyze to come up with parameters for appropriate arm's length pricing of transactions. And regulations, either in the US or in the foreign jurisdictions, give us a variety of methods that we can utilize to perform this analysis. Now, broadly speaking, these fall into two different buckets of methods. We have our transaction-based methods and our profit-based methods. Transaction-based methods, I'll give you a very crude example. So if we have a manufacturer and they sell a widget to their related party, they sell the exact same widget to a third party, you have a clear transaction in place there that could potentially be comparable, because if they sell it for $10 to the third party, you could argue that the same price should be applied in the related party context. Now, in practice, these transactions are difficult to identify. And I say that because even when they do exist, if you start to dig into the comparability factors, there are often reasons why tax authorities may throw them out and say they're not comparable. So back to that example, if the manufacturer sells 90% of its inventory to a related party and only 10% to the third party, suddenly that's not really quite so comparable anymore. And you may have to make adjustments. The actual price may be considered unreliable. So you have to really dig into all of the different factors of that transaction. As a result, the vast majority of transfer pricing analyses fall back on profit-based methods. And we see that also in statistics that we get from tax authorities in terms of their audits and their agreements that they enter into. So a profit-based method entails looking at the resulting profitability of certain companies within your control group. So instead of saying, how much should that widget cost, we would say, when that distributor sells that widget, at the end of the year, what level of profitability are they retaining? And is that appropriate? And is that in line with the level of profitability that we observe in third parties that are considered comparable to the entity that we're trying to benchmark? So that's typically the type of methodology that we fall back on most frequently. So how do we determine what is comparable when we're looking for data. How do we determine which entity we're even going to test? If we have a manufacturer and a distributor, whose profitability should we be looking at? So we have to undertake what we refer to as a functional analysis, and that entails looking at 3 key areas: functions performed, risks assumed, and assets employed. So functions performed, we look at in the controlled relationship, who is doing what. So what departments do you have? What is the functionality? Who is managing everything? Who reports to whom? What is being carried out over here versus what is being carried out over here? Risks assumed, we would look at, in that transaction, who's taking on the different risks associated with that transaction. So if there's a customer involved, who's taking on the risk of that customer not paying? Who's absorbing credit risk? Who's taking on financial exchange risk? Who's taking on inventory risk if something is damaged or broken, etc.? Then we look at assets employed. So in a manufacturing scenario, who owns the patents, etc. And then based on that analysis, we determine A, which entity we should be analyzing. Generally speaking, it's the simpler entity, the one with the least functions, risks, and assets, fewest functions, risks, and assets, sorry, because that should be the easier one to benchmark with reliability. And then we look for comparable companies that share those similar functions, risks, and assets. And then, to the extent we've performed that analysis, that gives you pretty good support for your transfer pricing to the extent you've got to that point and benchmarked it. What many companies would then do is move to the next step of compiling all of that information in a full transfer pricing study. Now, in the US, a transfer pricing study is quite a voluminous document. It consists of 10 principal documents. Those are set out in the transfer pricing penalty regulations. If you have all of these documents in place, to the extent that that compiles your transfer pricing report, if you're audited and you present that to the tax authority, your chances of being adjusted are now extremely minimal, because generally they accept a study if it's been prepared in compliance with the regs. And B, even if they were to contest your study, which they can do if they don't agree with the conclusions, you're protected from penalties. Broadly speaking, the study entails description of the business, an analysis of your industry, your organizational structure, your transactions, the analysis we just talked about, the functions, assets, and risks, and then the associated benchmarking. So that would be kind of the final step if you wanted to ensure you were fully compliant in terms of your transfer pricing support. And then why would we do this in practice? Well, first of all, I think it's clear that compliance is one of the rationale for looking at your transfer pricing. To the extent you don't have transfer pricing support or potentially a study in place, you could be subject to penalties. So there are rules in each jurisdiction. They're all slightly different depending on the jurisdiction. Some actually require you to file the study with the tax authorities. Most jurisdictions just require you to have it in place contemporaneously, i.e. at the time when you file your return. And if you're audited, you just have a very brief window in which to hand it over. If it's not in existence, or if you didn't have it in existence when you were supposed to, then you can be subject to adjustments and penalties. That can often create double taxation, because if you think about it, you're being audited 2 or 3 years down the road. The IRS says, sorry, you should have reported X amount in additional income because we don't agree with your transfer price. Here's a bill for your tax. Here's also a 40% penalty on top of the tax, which is the maximum penalty they can apply. If you then turn around to, say, China and say, 3 years ago, I reported too much income here. I now have to report it in the US. Could I please have my money back? China is obviously going to say no. So you've paid tax in China already, and now you're paying tax again in the US. There are potentially mechanisms to resolve that by getting the governments to negotiate with each other, but those typically entail a lot of professional fees, a lot of expense, a lot of time, a lot of energy. So unless it's a very large tax bill, oftentimes taxpayers end up just living with the double taxation. So you want to avoid that. But the more fun area of transfer pricing is the things you can do with it from a planning perspective. So in terms of carrot and stick, this is the kind of more of the carrot side of things. You can use transfer pricing as a planning tool. And that's an area that we like to highlight for our clients, especially now, because it's certainly something we're talking about on a regular basis, given the current tariff environment. So just thinking about tariffs, obviously transfer pricing can only be a tool to help you with tariffs to the extent you have intercompany transactions that are dutiable. If you're just buying from third parties, that's an arm's length transaction. You have ways to still plan for tariffs, but transfer pricing will not be one of them to the extent it's a third party. If it's a related party, however, we can look at the transfer pricing to say, okay, should we look at revising our transfer pricing policy? Can we model out a different scenario where we can adjust our intercompany price from China to lower that price so that our tariff impact is mitigated? Then you have the counter position to that, that if your import price is lower, your profits in the US will be higher potentially, so maybe more income tax, but that might be better than your tariff bill. And then there are other mechanisms, maybe additional service fees or some other mechanism to help minimize that income tax profit subject to income tax as well. So we do have some scenarios there that we're working with clients on to try and get a better answer for them in light of the tariffs. You can also look at whether your intercompany price is your dutiable price. They are different regulations in terms of the valuation methods applied. So you could even determine that perhaps the dutiable price should be something other than your transfer price. So that's another area that we've been investigating for clients also. Cash planning is a big one that we are frequently using transfer pricing as a tool to help our clients navigate where they want cash in an organization. So oftentimes the desire is to repatriate cash to the headquarters, or you may want to push more cash into one jurisdiction for expansion plans, etc. So you can look at all the different levers within the group to try and get the cash where you want it to be via transfer pricing. So you can maximize or minimize intercompany transactions to try to accomplish those cash planning objectives. That also ties into withholding tax. So let's say you have royalties and services that you have to pay intercompany. Maybe the royalties have a withholding tax, but the services don't. So maybe you want your services fee to be higher and your royalty to be lower, still to accomplish the same end result, but you can maybe get a better withholding tax answer through looking at your transfer pricing.
Tansy, just on that, Adam
Yeah.
had a question. Adam Nolan, do you want to just ask your question? We can't hear you, Adam. I think you're on mute. I can ask.
Sorry, yes, you may ask the question.
Okay, so yeah, Adam was just asking for an example of using different TP than dutiable price. An example.
Yeah, so there are different methods for customs valuation purposes than there are for transfer pricing purposes. So the transfer pricing regulations set out very specific methods that we have to apply. Customs has another set of methods. Oftentimes they correlate, and we can generally have our customs team review the transfer pricing policy and determine that they can rely upon the transfer price. And we've had them occasionally kind of put together memorandum for us to confirm that it does correlate with one of the methods for duty purposes. But there can be scenarios where you might be able to argue that a different method should apply. Now, I'm not a customs expert, so I don't know the details of the customs methods, but we have seen scenarios where we may be working with a profit-based method for transfer pricing, and then we're adjusting the pricing throughout the year for the inventory to try to hit a margin of, say, 3% for our distributor. So our price of our inventory kind of changes throughout the year because we're trying to get to that 3% rate. And the customs team can come in and look at those prices charged on import and then review the different valuation methodologies and come up with a slightly different aggregate answer for what the value should be that's subject to duties. Now, I don't know that that's very specific because unfortunately I don't know the details of all the trade methodologies, but they can potentially come up with a different valuation from the one that we end up using for transfer pricing.
Thank you.
Sure. And another point to that is also, again, if you make transfer pricing adjustments at year end, which some of our clients do, they may forget that they have to go back and then reassess whether that does impact the dutiable value that they declared for customs purposes. So if at year end they didn't hit that 3% margin, so they want to charge an extra amount to get them to that target margin, they also have to consider, does that then impact the dutiable value that was declared? So that's another area where we work with our trade team to determine if that gives rise to an adjustment for tariff purposes as well. So another area of planning is the next two kind of tie together. So utilization of tax attributes and global effective tax rate planning. So if you have entities in a group that have losses, for example, there may be an incentive to try and push some more income there so that you can utilize and offset those losses and get the benefit of those from a tax standpoint, or just in terms of looking overall at your statutory or effective tax rates in different countries. Clearly, if you've got a lower tax rate in one jurisdiction than another, there could be an incentive to maybe have more income in that lower tax jurisdiction. Again, within the parameters of what's defensible, we can use transfer pricing to kind of help model that out. And then an important one, which interestingly can be a priority for some of our clients, is exit readiness. So I've had experiences where we've talked to clients about transfer pricing and that they have risk or exposure, they need to comply, they could be subject to adjustments if they're audited. They don't care, they want to roll the dice. They say, well, we've got 3 years of the statute, let's cross our fingers and hope that the tax authorities don't come in and audit us. But as soon as you then talk about due diligence, suddenly it does become a priority. So we do have, especially in the private equity space, if you have portfolio companies, this can actually be more of a reason for them to prioritize transfer pricing compliance than actually any kind of fear of tax authority audit or adjustment, because in a due diligence process, if you are in an international group, it will be on the list. They will ask for your transfer pricing studies. And if you don't have them or you don't have any support, there could be potential exposure or liabilities that they identify, which could then impact your ability to negotiate the best purchase price on exit. So that is something to consider as well if you're in a company where there may be some thought of an exit strategy down the road. All right, and I think I am just about on time. So I'm going to talk just for a few minutes about base erosion and profit shifting. So this is an important initiative to be at least aware of when you're thinking about international expansion or activities, because it does underlie a lot of the initiatives that we're seeing globally. And I'll explain how the US kind of fits into this in a moment. But just to give you some background, BEPS, so base erosion and profit shifting, the BEPS project was initiated by the OECD and the G20 back in 2013. We now refer to BEPS as BEPS 1.0 because we now have a BEPS 2.0 as well. But the project was developed in response to growing concerns about the fact that multinational enterprises were using tax planning strategies to really kind of exploit gaps and mismatches in tax rules. And it allowed them to shift profits to low or no tax locations and avoid paying taxes. So the BEPS project aims to equip governments with various different tools to try to ensure that profits end up being taxed where the economic activities generating them take place and where value is created. So it consists of 15 actions were the output from BEPS 1.0, and they're designed to address various aspects of tax avoidance that included improving transparency, coherence, and also substance in international tax rules. So there's been widespread adoption and international cooperation on BEPS with 140 countries participating in the inclusive framework. And then what happened in 2019 is they launched kind of a second wave of BEPS, BEPS 2.0, as we now refer to it. And that's an extension of the original BEPS project, but this is much more focused at addressing tax challenges from the digitalization of the economy and ensuring multinationals pay a fair share of taxes on revenues that are generated through digital activity that doesn't stem from necessarily physical presence, boots on the ground, premises in a country, which is how original tax laws were crafted and founded, right? That concept of nexus and what gives you a taxing presence in a country, taxable presence in a country. So BEPS 2.0 has two main pillars. Pillar 1 is split into Amount A and Amount B, which are both entirely different for some reason, but they're both under Pillar 1. So Pillar 1 Amount A is trying to figure out how to create that new nexus rule as to how do you deem a company to have a tax liability in a country if it doesn't have physical presence, but it's generating a lot of income via its digital activities. Now, Amount A is applicable to companies with over 20 billion euros of revenue. So it only applies to a handful of companies. There are other thresholds too that narrow that universe even further. So for most of us, we don't need to worry too much about Amount A. And then Amount B, this one doesn't have any type of threshold. So this one does apply across the board. This is effectively what you might consider a safe harbor. So we talked about benchmarking and how you find data to analyze what your profitability should be for transfer pricing. There were lots of calls for kind of a safe harbor option for this to simplify and streamline some of these approaches. So this is something that applies specifically to distribution functions, which are seen, you know, it's a very commonplace activity that we see in transfer pricing scenarios globally. So there's a formulaic approach now to benchmarking distribution activities. And then Pillar 2, this is a really big one. We're helping a lot of clients with this right now. This is the global minimum tax. So this is a 15% global minimum tax, which is attempting to stop that race to the bottom of countries just lowering their tax rates to pull more business into their jurisdiction. So it sets a minimum effective tax rate of 15%. Right now, this only applies to companies with global consolidated revenue of 750 million euros, about 850 USD is our equivalent, the threshold we use in the US. So it is only applicable to larger companies. Likely in future, that may reduce, but right now it's only applicable to that scale of company. So in terms of key outputs, BEPS 1.0, one of the areas that came out of that that's very applicable to us is the way that transfer pricing documentation is structured. Now, the US didn't adopt this approach. We have those 10 principal documents that I outlined earlier, which go into a full US study. Almost everywhere else in the world follows this approach, where you have a master file, which explains your organization and kind of your broad business overview. You then have a local file for each country in which you operate, which has that economic analysis that we talked about, the benchmarking, the specific transactions. And then the really important new piece was this country by country report. This is only applicable currently to those companies above 850 million USD in global revenues. I believe that that threshold will lower in future. They want this to really incorporate more businesses down the road. But it basically gives the tax authorities the ability to see your global footprint. This is a snapshot of a piece of the form that you have to file, your CBC form. So you have to declare all of your tax jurisdictions, your entities, where your revenue is coming from, whether it's from related or unrelated parties, your profit or loss before tax, your number of employees. So if tax authorities see you have all your revenue in the British Virgin Islands and you have 0 employees there, you're going to get flagged for audit pretty quickly. But these forms are shared with all the tax authorities where you're doing business. So you file it in your parent company jurisdiction, and then they share that form with all the other tax authorities. And this year, Australia and the EU are making this also public. So there's a requirement to file this information, not just with the tax authorities, but you share it with your clients and your competitors as well. So that's a huge shift, much more transparency, a lot of data available for tax authorities to see if you might be doing something that they think is potentially resulting in profit shifting. BEPS 2.0, just current status update. So Pillar 1, Amount A, that's the $20 billion companies. That's effectively stalled. What we're seeing now is individual countries are bringing in digital services taxes because they just can't get the political consensus around Amount A. A lot of that is coming from the US perspective as well. So that's not moving right now. So we'll see if or when that progresses. Amount B, interestingly, the US is one of the few that has adopted Amount B. So this is that streamlined approach to calculating your remuneration for your distributors. The US has adopted it as an elective method, so you can choose whether or not you want to use it. Right now, countries are really waiting to see what others are going to do. So it hasn't been broadly adopted. So our clients really aren't moving forward with adopting Amount B yet. They're still just doing the traditional benchmarking approach to determine how to remunerate their distributors. Although the Trump administration did issue a memo back in January, effectively pulling out of the global tax deal, they kind of left Amount B intact, which isn't surprising because it's not very controversial and it actually helps tax authorities by kind of streamlining the effort needed to come up with routine returns for distributors. So we'll see where that goes. But right now, technically, you could use it in the US if you wanted to. And then Pillar 2 is the global minimum tax. The US has not adopted the global minimum tax. They are still engaging in talks at the OECD, which is, I think, a hopeful sign that even if we don't adopt it, there'll be some degree of discussion to ensure that if the rest of the world does adopt it and the US doesn't, we're not going to end up with a lot of double taxation and a lot of controversy trying to reconcile the US rules with the rest of the world. But right now, 72 countries have enacted the global minimum tax. So again, this only relates to companies larger than 850 million, but I think in future, we'll likely see that trickle down. So this is all the stuff that's going on globally. Now, a lot of this may not apply if you're below those larger thresholds, but I think it's still interesting to see how these discussions evolve because it is demonstrating kind of a move towards more kind of global consensus around how we approach transfer pricing and taxation of multinationals. It's trying to stop all these kind of races to the bottom in terms of tax rates globally. So you're unlikely to see countries kind of trying to move to these very low tax rates because they're going to get caught out by the Pillar 2 rules that'll come in and say, well, you can say your tax rate's 12.5, but we're going to capture that extra 2.5 through our 15% global minimum tax. So just the kind of general concepts here, I think are applicable really to all businesses and a lot of focus on substance as well. And I think just to take us into takeaways, and I'm going to try and leave at least 15 minutes or so for any questions. But I think these are the key areas I wanted you to think about. So, and a lot of this all ties together, but beware of regulatory complexity. So obviously we've talked about if you expand internationally, the regulatory requirements are going to be exponentially more complex. Understand the local nuances. It's really important to consult with local experts. Don't just look at everything from a US-centric perspective because there are very specific local nuances and requirements in each jurisdiction that you want to be aware of before you proceed with your structure, your intercompany transactions, etc. Understand your disclosure requirements. So we talked about BEPS. So a lot of that is around increased transparency. So a lot of requirements, especially in the EU as well, and here in the US, to file a lot of disclosure related information that may not necessarily feed into your tax calculation, but they want to see and know everything. And there can be pretty steep penalties for missing any of those requirements. Don't let the tax tail wag the dog. So this kind of plays into the next point as well. You need substance. So you can't just, set up your PO box in the BVI and shift all your profits over there. That's not going to fly anymore. You need to think about, where is the business really going to operate? Where are you going to put human beings? You might want to put your intellectual property in Ireland because it's got a great tax rate there. But if you don't want to employ your chief technology officer in Ireland, then it's still not really going to do what you want it to do from a tax standpoint. You need to have not just people, but decision-making abilities, risk-taking abilities in those countries to really justify that that's where things are owned and where the value is being created, and where you should therefore be reporting your profits. So think about your business, your commercial plans, which countries you want and need to be in, and then layer on the tax versus trying to figure out where's the most tax beneficial jurisdiction for us to be. Substance is key. So again, you need actual behavior, facts, boots on the ground, decision-making capabilities to be able to support your argument for tax purposes. And then the golden rule for transfer pricing, what would third parties do? Sometimes we see clients fall into the trap of thinking, well, it's one business, so I'm going to treat it as one business for tax purposes, and I need money over here, I need money over here, I'm gonna wire the money because they need the money, and we move it around the group because that's where we need it, without fully thinking through the implications of that. What is that transfer? Is it a loan? Do you expect it to be paid back? Then it needs to be documented, there needs to be interest. Are you paying for some services that you received? And there needs to be an invoice, and you need to transfer price those services. Is it an equity contribution? Do you never expect that money to come back? You need to really think through what all those transactions really are. So again, what would a third party do in that scenario? If you always take that step back and think about that for transfer pricing, then you're already kind of one step ahead in terms of mitigating any risk from a transfer pricing perspective. So that was all I have for today. Let me stop sharing.
Amazing. A lot of really, really valuable content there, Tansy. I have to say, a lot of it has gone over my head, but I'm sure it's resonated with a lot of people who are, obviously CFOs within businesses. Thank you so much. We really appreciate it. I guess we're a reasonable number, actually. People just want to kind of jump in with any questions. I don't need to you don't need to put in the chat, just chat amongst ourselves, any experiences you want to share, or if there's anything specific that's come up from the presentation. Molly, you've just popped something in the chat. Do you want to ask Tansy? I can ask. I don't know. On mute. So Molly's question. Oh, you're there. Go ahead.
Hi, yes. So I'm very, very new to this. So thank you very much for all of what you've shared. And I am just curious. So within the software space, is there a particular trigger in which, when you do sell outside the US, that is it just depends, like just say, for example, you're selling in the UK, and is there kind of that, maybe 100,000, you should probably be thinking about it, or should you be basically thinking about it as soon as you, sell $1 to the UK?
Thanks, Molly. So there'll be different taxes that you need to think about. So if we're talking about income tax, then generally, unless you're physically in the UK, performing certain functions, negotiating those contracts, signing contracts with customers, if all of that's happening in the US and all you're doing is selling to UK customers, you're likely not triggering a taxable presence in the UK for income tax purposes. So you're probably not giving yourself a branch or a PE. Now, I caveat this is not my area of expertise. I'm a transfer pricing specialist, but I know enough about this to be dangerous, I guess, as they say. So I think as long as you're not physically sending people there and negotiating and doing things on the ground, or you don't have an office there, you probably haven't given yourself a branch, so you probably don't need to pay income tax on it. Now, what I don't know are the kind of other indirect tax implications. So in the US, we have sales tax, for example. In the UK, you might have VAT consequences on things. And I don't know how the indirect taxes would apply in this case. There might be people on the call that know this answer, but that would be something you would need to check just to determine if there's anything from an indirect tax. And I would guess VAT is the main one. Probably not, but that's something you would need to look into. But from an income tax perspective, I think you're fine as long as you're not sending people or like you have a leased building or something like that over there. Does anyone know about VAT on software? I know people who know that answer. So if you want to email me, I can find that out for you pretty quickly.
Tansy, it's Adam Nolan again. On that question that was just asked, the pillar, sorry, I think pillar 1B,
Yes, amount B.
isn't that a sort of an example of there would be some sort of nexus criteria based on sales volume, even if you don't have a presence? I guess that's how I interpreted the BEPS slide. But maybe not.
Sorry, which do you mean amount A? That's the
So that was the 700, or sorry, the 20 billion in revenues. But then I thought you said there's the one amount B, which was some more simplified formula, but I guess I was thinking that it still reached down at a lower level.
Yeah, so that amount B and amount A are completely unrelated, which I find it odd that they put them both under pillar 1. Amount B is where you have a distribution entity in a jurisdiction that is engaging in controlled transactions. So if you have a distribution entity in the US and it's buying from China, and all it does is buy the product and sell to its customers, and it's buying from a related party.
Yeah.
Traditionally, what you do is benchmark it, and that's a whole process. You have to analyze data. Now they have a formulaic approach where you look at what industry is it, you do some asset intensity ratios, and then it literally tells you your margin should be 2%. That's a very simplistic version of it, but you kind of just go through some formulaic questions, and instead of doing the benchmark, which takes a long time, you can do this formulaic approach and say, well, it should be 2%. But then you have to ensure that the government on both sides has adopted amount B in order to respect that. And right now, there aren't many that have adopted it. So a lot of clients are shying away from using it because even if it works on one side, the other side might take issue with it. So then you still have to do the benchmarking to keep the other side happy. So does that answer the question?
Yeah, again, sort of distinguishing factor in the example that was asked by, I think, Molly, they don't have a distribution entity in the UK versus your clarification makes it abundantly clear. Thank you.
Yes. Yeah.
Perfect. Any more questions? I think you've explained it all so perfectly well, Tansy, that you've covered every potential question.
Well, sorry to Christine to ask another question. I guess, Tansy, as you think about services as opposed to goods, any other thoughts or wisdom that you would give us?
On services. Yeah, services is a fun one because a lot of people, goods are kind of easy from a transfer pricing perspective because you see something happening, so you know it's happening, so you price it. And services, companies may not even recognize that they're happening. So sometimes there's not even a transaction showing up on the books to flag the fact that you have intercompany services. So it's one we often see missed. And it can be, well, really important from a compliance standpoint to make sure you are recognizing where there are intercompany services, but B, a really good planning tool as well, because there's a lot of ways you can approach services to model out different scenarios and kind of get the best answer. You have kind of a lot of gray that you can work within in transfer pricing. So generally, every multinational has services in place because typically you have a headquarter company that's going to have the C-suite. They probably do some back office support. You might have all the accounting function in the headquarters. You might do the IT support, the HR support. You might have R&D services somewhere. So there's lots of opportunity to look for where those services arise. Then to calculate how you transfer price those services, there's normally a two-step process. So first of all, you have to figure out what your costs of performing the service are. So we call that cost allocation. That you can get quite creative around, because you could look at different ways to determine, how much does it cost me for my C-suite to support these 3 subs versus how much of their cost relates to what I'm doing here in the US. So you kind of have to figure out that cost base. Then on top of that, you can potentially apply a markup. There are some safe harbors around services as well. The US allows some services to be recharged without a markup at 0%. Under OECD rules, there's a 5% safe harbor for low value services. Or you could do a benchmark and decide you want to charge them at 12% markup. So there's lots of different things you can, lots of different paths you can go down to figure out, A, what are my services? B, what is the cost base of those services? C, what is the markup on those services, to come up with your overall policy. So definitely an area that we see missed, especially the headquarter function. So one to be more wary of, because it's not so clear cut when and where those are happening.
Great, thanks.
Wonderful. Sure. I'm conscious of time because we allotted an hour and 4 minutes until the hour. Tansy, are you happy for me? I know you sent the PDF. Are you happy for me to share the slides and your contact details, just in case anyone has any follow-up questions that they want to?
Of course. Yeah, okay. Absolutely. And
okay.
Please connect with me on LinkedIn, and send me notes if I can help with anything. Drop me a line.
Okay.
Everyone.
Thank you so much. It's been really informative, and I know you're busy, so really appreciate you taking the time out to prepare, and I'm sure everyone really appreciates it as well. There will be an email that you'll receive after the session. There'll be some links in there to some of the resources that we offer, CFO Recruit. Some of you will know us, well, most of you will, but if you're looking to change positions, we support you through that process. So you can see on our website the different resources that are available to you. And I will also include the slides from the presentation and contact details for Tansy. So with that, I think we can formally bring the session to a close, and thank you all very, very much for your time.